Good morning, students. Welcome you all on the video lecture on Ind AS 36 impairment of assets. I hope I am audible to everyone. So today we are going to talk about one and very important standard, which is impairment of assets, right? So far, we have understood so many asset related standards like Ind AS 16 property, plant and equipment, Ind AS 36, Ind AS 38 intangible assets, Ind AS 40 investment property, right? So Ind AS 105 non-current assets held for sale and discontinued operations. So we have so many asset related standards, right? And we have also talked about in case of PPE, depreciation should be there, right? In case of intangible assets, amortization should be there. In case of investment property, again, depreciation should be there, right? So what is meant by impairment? When impairment is required, impairment is a negative term, right? So there could not be an impairment of liabilities because impairment of liabilities is a positive thing, right? So impairment word is used for the purpose of assets. What is meant by impairment of assets? So I will discuss and I will make you guys understand with the help of an example that what is impairment of assets, what is meant by impairment, okay? And how this impairment is different from depreciation, right? Friends, if I differentiate between impairment and depreciation, let's say there is a person who is Mr. Ram. Mr. Ram has purchased a car. Mr. Ram has purchased a Skoda car, for example. And Mr. Ram purchased a Skoda diesel car. Okay. The cost of the car was 20 lakh rupees. The life of the car was 10 years. So every year, what would be the depreciation, assuming that residual value is zero? What is the depreciation per annum, guys? What is the depreciation per annum? Happy New Year, Manini. Happy New Year, Rahul. Yes, the depreciation of the car is 2 lakh rupees per annum. 20 lakh divided by 10 years, 2 lakh rupees per annum. Okay. What is the next year depreciation? Again, going by the straight line method, the next year depreciation would be again 2 lakh rupees. Now the thing is, let's say at the end of 2 years, right? Since this car was purchased in Delhi, okay. So government has banned the diesel car, okay. When the government has banned the diesel car, probably when you were charging depreciation and at the end of the second year, the carrying value of the car was 16 lakh rupees, right? 20 minus 2 minus 2, 16 lakh rupees. But when government announced a decision that diesel car due to pollution, diesel car will ban in Delhi. Now tell me whether the market value of the car will go down, because you are assuming that 20 lakh was the original cost. 2 years has already passed. So probably the carrying value of the car should be 16 lakh rupees. And this is what you have depreciated so far, right? But the point is, with this decision, with this announcement of government, whether the market value of the car will go down? Yes or no? Yes, the market value of the car will go down. So probably when you will go to Kirtinagar market and you will ask about what would be my selling price of the car, probably before the decision of the government, probably the value of the car would be approx 16 lakh rupees. But after the decision or announcement by the government, the value of the car will go down drastically, right? Now, when the value of the car will go down, okay, so what does it mean? Is it depreciation? Is it depreciation? Because depreciation is a systematic useful life. It's a systematic charge over the useful life, right? So depreciation is a systematic charge over the useful life. This is not a depreciation. What is this? What is this? If this is not a depreciation, then what is this? This is impairment. This is impairment, friends. So the cost of the car was 20 lakh rupees. The first year depreciation is 2 lakh rupees. The second year depreciation is again 2 lakh rupees. The carrying value of the car is 16 lakh rupees. But when you go to the market to sell this car, probably the market value, the fair value of the car comes to rupees, let's say 10 lakh rupees, right? Why? Because government has already given a negative decision, right? So friends, the car is banned in Delhi, but the car is not banned in rest of the India. So the dealer is saying, first of all, there is a negative announcement. There is so many seller would be there, right? So buyers should be limited, and we have to sell this car in the another state. So there are some transportation cost, other charges as well, and hence this market value has gone down, right? So friends, when I talk about depreciation, depreciation is a systematic charge over the useful life of the assets, right? Systematic charge over the useful life of the assets. But if I talk about impairment, impairment is a one-off event, right? If I talk about depreciation and if I differentiate it with impairment, so what is the difference between depreciation and impairment? Depreciation is a systematic charge. It's a systematic charge over the useful life of the assets. Impairment is a one-off event. It's a one-off event, right? If the government would not have announced such a notification or such a decision, probably the value of the car has not been gone down, right? Whether the efficiency and productivity of the car has gone down after such announcement, answer is no. The car, so whatever the performance of the car was there yesterday, it will be tomorrow, it will be today as well, right? There is no change in the productivity, efficiency, and performance of the car, right? But yes, the value of the car has gone down. So depreciation is something relating to the consumption of the asset, right? It is relating to the consumption of the asset. When you consume the asset, the value of the asset will go down. It is somehow related to the consumption of the asset. But if I talk about impairment, impairment is not related to the consumption of the asset. It is related to some indicators. It is related to some market situation. It is related to indicator. It is event based. It is event based, right? This is event based. Okay. When I talk about depreciation, it is a regular. Depreciation is regular. When I talk about impairment, it is extra hit. It is extra hit. Okay. Extra hit in the P&L, which is over and above depreciation. So have you understood the difference between depreciation and impairment? Yeah. Have you understood the difference between depreciation and impairment? So friends, in this case, what is the impairment? The carrying value is 16 lakh rupees. What is meant by carrying value? Value in the books of accounts. Value which is carried in the books of accounts, right? So the value which is carried in the books of accounts is 16 lakh rupees. What is a market value? What is a fair value? It is 10 lakh rupees. So it means the difference is 6 lakh rupees, and this 6 lakh rupees will go into the P&L, which is impairment loss, right? So impairment loss, when impairment loss will come into picture? Impairment loss will come into picture when your market value, when your fair value, when your recoverable value, fair value means your recoverable value, what is you are going to recover, whatever you are going to recover, that value is lower than your carrying value. In this case, your fair value is lower than your carrying value, and hence 6 lakh rupee is your impairment loss. It is your impairment loss, right? I hope it is clear to everyone. Yeah. I hope it is clear to everyone. So Manini is saying, even if we don't consume, we charge depreciation. Manini, you are right. If it is available for use, we are charging depreciation. But somehow, if you look at the depreciation, right, concept of the depreciation, the concept of the depreciation is a consumption based, right? What is meant by consumption based? For example, Manini, you have purchased a car, okay? Normally, the life of the car is 15 years. If you see the RC, registration certificate, you will find that the life of car is 15 years, right? So let's say if you will drive the car or if you will not drive the car, the depreciation will charge by efflux of time as well. Whenever the time passes, of course, you need to charge depreciation, right? When I'm talking about consumption, if there is a car which is standing in the garage, even the battery will go down, even the tires, okay, the tires will also get scrapped, okay. So consumption, I mean to say efflux of time as well, okay. But impairment is not due to efflux of time. I'll take another classic example, right? A company has purchased a machinery from China, right? So when the machinery came into the premises of the company in India, the cost of the machinery was 1 crore rupees, right? So the cost is 1 crore rupees and the company recently purchased this machinery. So market value is also 1 crore rupees because the company has purchased at market value. So whatever market value is there, the government and the output which is produced by that particular machinery, the government has banned that output. Okay. So the particular output which is produced by that machinery, government has banned that output. Now tell me, the machinery is only, let's say, 1 week old. Whether the market value of the machinery will go down or it will not go down. Earlier, there was a huge demand of that machinery, right? But after such an announcement by the government, whether the market value will go down, answer is yes. Although the machinery is just 1 week old. If I talk about depreciation, probably there is no depreciation. Why? Because probably the machine has not yet installed. It is not yet available for use. So depreciation has not been started. But yes, impairment would be there. Have you understood this? Yeah. So impairment should be there. Impairment should be event based, trigger based. It's kind of a one-off events. And it is, of course, over and above of depreciation. It is extra hit to the P&L. Okay. Like in COVID scenario, when this COVID came, a lot of companies have started doing the impairment exercise, right? A lot of companies have shut down their operations. A lot of companies' business has gone down, right? So in every businesses, there is some impact, right? And they have done this impairment exercise as well. Okay. I believe you all have understood the concept of impairment, right? Impair means decrease, decline. Okay. Now let's come to the agenda, friends. As far as agenda is concerned, we'll talk about what is the objective of this standard, which is a theoretical part, scope of this standard, and meaning of impairment loss. Then we will be talking about identification of an asset that may be impaired. Friends, please mind these words, identification of an asset that may be impaired. So friends, practically, theoretically, everything is okay. But since you guys are the future chartered accountants, when you become a CA and you will job in and you will work in industry or you will audit it, you will be in the auditing field where you will be auditing the financial statement of the companies, then you will look at impairment is not a theoretical exercise. Impairment is a cost compulsive exercise where you need to get the valuation done by the valuers, right? And it is also time consuming exercise. You have to engage valuers, they will take time, right? And they will take money as well. So that is why standard says that you need to identify the asset that may be impaired. But how you identify the asset which can be impaired, we will discuss it, right? Once you have identified the asset that may be impaired, in that case, you have to measure recoverable amount. What is meant by recoverable amount? The amount which can be recovered from that asset, right? So recoverable amount is your fair value, market value, or value in use. We'll talk about these terms as well. Friends, if there is an impairment loss, then we will discuss where to recognize, right? Recognition means recognition in the books of accounts, right? Recognition. So where to recognize this impairment loss in the books of accounts and how to measure an impairment loss. Friends, you understood there are 4 pillars of accounting. RMPD, you understood this? Recognition, measurement, presentation, disclosure. Please write down these 4 things. RMPD. R means recognition, M means measurement, P means presentation, D means disclosure. RMPD. Okay. Recognition, measurement, presentation, disclosure. Right? So then we are going to discuss where to recognize impairment loss and how to measure your impairment loss. Friends, in this chapter, in this standard, we will be talking about the impairment of individual asset as well as the impairment of the group of assets, right? When there is an individual asset, it is an asset impairment. When there is a group of asset, it will be known as CGU. What is the full form of CGU? You must have read the CGU in your accounting standard 28 as well, right? Manini, Srishti, Koshiki, right? Sumit, Rahul, am I right? You must have read the concept of CGU in your accounting standard 28 as well. Impairment of assets. CGU concept. Have you read in AS 28, accounting standard 28? Yeah. Cash generating unit. What is group of assets? Cash generating unit. We will be discussing the cash generating unit concept as well. And goodwill and corporate asset. These are three important concepts, right? How to do the impairment of assets in the group of assets, in the CGU. Okay. And how to allocate goodwill, right, in the group of assets, which is CGU. And what is the treatment of corporate asset? We will be covering this part also, and this is a very important part, I would say. Then we will be talking about allocation and reversal of impairment loss. How to allocate an impairment loss in the group of assets. If there are group of assets and there is an impairment loss in the entire group, so how to allocate that impairment loss in the group of assets. And reversal of impairment loss. Can the impairment loss be reversed? Right, answer is yes. So if the impairment loss can be reversed, how to reverse an impairment loss, we will be talking about this thing also. Then the last point is disclosure, right? Disclosure. Clear? Okay. So friends, we are discussing Indian Accounting Standard 36. What is the, if you guys have also opted for GFRS paper, which is elective paper, right? In GFRS, of course, IFRS is there. So what is the counterpart standard of Ind AS 36? It is IAS 36, International Accounting Standard 36, right? There is no much difference between Ind AS 36 and IAS 36. It is substantially same standard. If you have understood Ind AS 36, you have understood IAS 36, right? That's all. Talking about accounting standard, it is accounting standard 28. Comparing to AS 28 with Ind AS 36, there is no much difference between AS 28 and Ind AS 36 as well, right? So friends, talking about impairment of assets, the title is impairment of assets. As I have told you, there is no impairment of liabilities, right? You are saying my liabilities has gone down. It's good news for you. If your liabilities has gone down, it is not impairment. It is a favorable thing, right? So this is not known as an impairment. So that is why the word uses impairment of assets. Now, so what is meant by impairment of assets? So if the value of the asset goes down, if the value of the asset declines due to the other factors, right, it is known as impairment of assets. In this standard, largely, this standard talks about the impairment of PPE under Ind AS 30, under Ind AS 16, right? PPE is Ind AS 16. This standard talks about the impairment of intangible assets under Ind AS 38. This standard also talks about the impairment of investment property, which is Ind AS 40, and goodwill as well, which is largely arise from business combination, Ind AS 103. So friends, this standard talks about largely these four kind of impairment: property, plant and equipment, intangible asset, investment property, goodwill. Sir, what about inventory? Friends, if there is any impairment of inventory, it is taken care by inventory standard itself, right? Why? Because in inventory, what is the formula? Inventory has to be measured at cost or NRV, whichever is lower. What is NRV? Net realizable value. If your cost is higher than net realizable value, you have to reduce the value of the inventory. You have to charge impairment on the inventory, right? So impairment on inventory is already taken care by Ind AS 2, right? Sir, what about biological asset, agriculture assets? So biological asset has to be measured at fair value less cost to sell at initial recognition and subsequent recognition. So for example, initially you have measured your biological asset at fair value, which is 10,000 rupees. Subsequently, again, you have to measure your biological asset at fair value. Now the fair value has gone down to 9,000 rupees. So you will decline the value, record the impairment and remeasure it at 9,000 rupees. So it means your biological asset will always be at fair value going by the Ind AS 41 standard. Sir, if there is a bearer plant, since bearer plant is not covered under Ind AS 41, so it will never be fair valued. So if it is a bearer plant, then impairment of bearer plant will be covered where? So bearer plant is covered under Ind AS 16 and this standard is taking care of PPE. So this standard is taking care of the impairment on PPE, right? Sir, what about financial assets? What about impairment is already taken care by Ind AS 109, right? ECL model, expected credit loss model, impairment of financial assets. So financial asset has to be measured at fair value. So impairment on financial asset has been taken care by Ind AS 109 itself. So friends, sir, what about non-current assets held for sale in discontinued operations? So friends, in case of non-current asset held for sale, again, non-current asset held for sale has to be recognized at carrying value or fair value less cost to sell, whichever is lower. Again, going by the lower concept, impairment has already been recognized as per Ind AS 105. Subsequently, the non-current asset held for sale is again remeasured at fair value less cost to sell. It is remeasured at fair value. So again, the market value, again it is remeasured at market value. Okay. So it means the impairment on non-current asset held for sale is already taken care by Ind AS 105 itself. Right. So friends, the impairment of other assets has been taken care by the respective standard itself. And that is why largely Ind AS 36 is applicable on property, plant and equipment, intangible assets, investment property and goodwill. Right. I believe so far you all are good. Right. Are we comfortable so far? Friends, any doubt, any challenge? Yeah, I spent a lot of time just to create the context for this standard. Is it clear to everyone? Shall I move forward? Great. Thanks, Radhika. Yes. Coming to the objective, like every standard has an objective. Why this standard has been issued? So this standard is important. Why? Because this standard ensure that assets are carried at no more than their recoverable amount. As simple as that. In the books, if the cost of the asset or if the carrying value of the asset is 10 lakh rupees, if the carrying value of the asset is 10 lakh rupees, right? In that case, but the recoverable value of the asset is, let's say, 6 lakh rupees. In the example of the Skoda car, diesel car, the carrying value was 16 lakh rupees, right? But the market value or fair value was 10 lakh rupees. So what is the objective of this standard? The objective of this standard is to reduce the value to the recoverable amount, right? And whenever you are reducing the recoverable value, reducing the carrying value to the recoverable amount, there is an impairment loss. Okay. So the entire objective of this standard is to ensure that your carrying value in the books of accounts should not be more than whatever is the recoverable value, right? This standard also talks about how to determine the recoverable amount. What is meant by recoverable amount? Recoverable amount is higher of fair value less cost to sell and value in use, right? So we will discuss later on that what is meant by recoverable amount. It is higher of fair value less cost to sell and value in use, VIU. Fair value less cost to sell and value in use. We are going to discuss both these concepts. Then how to allocate and reversal of impairment loss. How to allocate impairment loss and when impairment loss can be reversed and reversal can be booked. Then the last one is disclosure. Disclosure of impairment losses, right? Coming to the scope part, Ind AS 36 applies to all assets except, but largely in all assets, largely it is PP, intangible asset, investment property, and goodwill, largely. Ind AS 36 applies to all assets except inventories. On this, Ind AS 36 is not applicable because Ind AS 2 itself take care of impairment by the formula cost or NRV, whichever is lower. Ind AS 115, under Ind AS 115, the contract assets and assets arising from cost to obtain or fulfill a contract, the impairment is taken care by Ind AS 115 itself for contract assets, and hence Ind AS 36 is not applicable on this Ind AS 115 asset as well. Deferred tax assets, Ind AS 12. So again, Ind AS 12 says that you have to remeasure your deferred tax assets at every reporting date. So it is taken care by Ind AS 12 itself. Assets arising from employee benefit has to be measured at fair value. It is taken care by Ind AS 19 itself, right? And hence on these contract related standard is taken care by Ind AS 104 itself, right? Non-current assets classified as held for sale, as I told you, it is taken care by Ind AS 105 itself. Financial assets, it is taken care by Ind AS 109 itself, right? I hope it is clear to all of you so far. Yeah. So Koshiki bearer plant is a concept. Bearer plant is covered under Ind AS 16. Bearer plant are those plant which produce agricultural produce, which produce the output for more than 1 year, right? For example, mango tree. Mango tree produces mango for more than 1 year, right? For example, if you have a mango tree in your garden, you will get the mangoes for 20 years, 30 years. So mango tree is known as a bearer plant. Okay. So bearer plant means which bears fruits, which bears the output for more than 1 year. And bearer plant is covered under Ind AS 16 PPE. Okay. Yes. So what is meant by impairment loss? Impairment loss is the amount by which the carrying amount of an asset or a cash generating unit exceeds its recoverable amount. Okay. So when carrying amount is greater than recoverable amount, then it is impairment loss, of course. For example, the carrying amount is, let's say, 100 rupees. The carrying amount is 100 rupees, but the recoverable amount is 80 rupees. So in that case, carrying amount is higher than recoverable amount. So what we need to do? We need to reduce the carrying amount to the recoverable amount. So we need to recognize the impairment loss of 20 rupees, right? So carrying amount minus recoverable amount is equal to impairment loss in this case. Is it clear? Carrying amount means amount carried in the ledger, amount carried in the books of accounts. Recoverable amount means the amount at which the asset will be recovered. The recoverable value of that asset is known as a recoverable amount, market value largely. Okay, clear? Now, what is meant by recoverable amount? Recoverable amount of an asset. I have told you that we will be going to talk about asset or cash generating unit, asset or group of assets, right? Assets or group of assets, right? We will be going to talk about assets or group of assets. So group of assets in this standard is known as cash generating unit. Okay. So now we are talking about, we understood carrying value. Carrying value means value which is carried in the books of accounts. Now we need to understand what is recoverable amount. So recoverable amount is higher of what? Higher of fair value less cost to sell and value in use. What is meant by fair value less cost to sell? Friends, fair value less cost to sell is nothing. Fair value less cost to sell is your market value largely. It's your market value. Value in use is not market value. It's an entity specific value. Entity specific value, right? So fair value less cost to sell is like a value which you get by selling the asset. Value which you will get by selling the asset. Fair value is like a value. It's like a value. It's like a value. Value by selling the assets. Value in use is a value which you will get by using the assets. Sir, what does it mean? For example, let's say you have purchased a car, okay? And you are using that car for transportation purposes, right? Commercial purposes. So now you have to compute the recoverable amount. So you go to the market and you ask that what is the sale price of this car? If I want to sell this car, what is the price of this commercial vehicle? So in the market, the let's say I would say in the market you will get a price. For example, you went to True Value or you go to First Choice, right? So they have quoted the price of 10 lakh rupees for that car. Okay, so this is a market value, and of course you will get 10 lakh rupees only when you will sell the car. So this is a market value, and the company also tells you that if you want to sell this car, you have to pay this much of commission or brokerage, and this is the transfer charges. For example, when you go to the carsdekho.com or this cars24.com, right? My brother has sold the car in the last month. So they have charged some commission and they have also taken some transfer charges as well, right? So net the value of the car was 3 lakh rupees, which they have quoted, and they have deducted around 15,000 rupees for some charges or something extra. So it means the fair value of the car is 3 lakh rupees. But the cost of disposal, cost to sell is 15,000 rupees. So what is the net fair value less cost to sell? It is 3 lakh minus 15,000. So my brother got 2,85,000 in his hands. Okay. This is the fair value less cost to sell. Now, what is meant by value in use? If the company or that person will use that car for transportation and the remaining life is, let's say, 7 years, right? So in the 7 years, he will get the money by renting that car or by using that car for transportation purposes. So how much cash flow he will generate in the next 7 years? For example, a person will say that, so I have already, deployed this vehicle in the school. Okay. And they were using this vehicle for the school, for commuting the school children, school kids, right? And every month I am getting, let's say, 50,000 rupees every month, right? So every month 50,000 rupees means 6 lakh rupees in a year. And if I will get, let's say, 6 lakh rupees in the next 7 years, okay. And of course, as per my contract, there is a escalation clause of 10% every year, right? So friends, in this case, by using this car, how much cash flow I would be able to generate net of cash outflow as well, right? If I'm getting 50,000 rupees, probably the cost of the fuel belongs to me only, right? I have to incur the cost of fuel as well. So for earning 50,000 rupees, probably I have to incur a cost of 15,000 rupees, 1515. So what is my net inflow? My net inflow is 35,000 rupees per month. So if I compute 35,000 rupees multiply by 12, which is net cash inflow, multiply by 7, of course, I'll factor some inflation also, escalation also. So probably in the next 7 years, let's say I'll get 40 lakh rupees or 35 lakh rupees, right? But the 40 or 35 lakh rupees I will be recovering in the next 7 years. So what is the present value of the future cash flows? What is the present value of the future cash flows? And when I'm talking about cash flow, cash inflow net of cash outflow, right? Because whatever cash inflow I will be earning, I will be generating, there will be some cost as well, which I have to incur, right? So you have to take the net cash flows. Okay. So then you have to discount those future cash flows and take it to the present value on the date of reporting, on the reporting date or on the date of measurement. So what is your value? Then that is why this value in use is an entity specific value, right? Why entity specific value? I will take a classic example of CA only, right? You guys are working in a CA firm. So there is a chartered accountant who is charging, let's say, 1,000 rupees for GST return filing. And there are chartered accountant who are charging 10,000 rupees for the GST return filing, right? The work is same. It's GST return and department is same. The compliance is same. The provisions are same. So one CA charging 1,000 rupees, one CA charging 10,000 rupees. So what is this? This is entity specific value, because if that CA will measure its assets by value in use concept, so probably his value in use is much larger than the value in use of that CA who is charging such a small money. Are you getting me? And that is why even if I talk about the value in use of big four, I mean to say the market value of big four or market value of a small firm, right? For a small firm, probably the client is not able to pay 50,000 rupees for an audit fee. But if big four will come, probably the client would be happy to pay 3 lakh rupees, 4 lakh rupees, right? Why? Because their value in use is higher. Their market value is higher. You understand? So value in use is a cash flow based value. And that is why it is considered as an entity specific value, right? And how value in use is computed? It is present value of future cash flows. Future cash flow. Cash flow means inflow net of outflow. Have you got this? Guys, have you understood this? Fair value less cost to sell and value in use. I believe you got this concept. Yeah, is it clear? Great. Okay. So the carrying value of a building in the books of ABC Limited as on 31st March 2016 is rupees 250 lakhs. The carrying value is 250 lakhs. As on that date, the value in use is given, which is 200 lakhs. And the fair value less cost to sell is also given. Fair value less cost to disposal or cost to sell is also given, which is 188 lakhs. So what is higher here? What is a higher value? What is higher? The higher value is 200 lakhs, right? So what is my impairment loss? And of course, the carrying value is 250 and your recoverable amount is 200 lakhs. So what is my impairment loss? My impairment loss is equal to carrying value minus recoverable value. So it is 250 minus 200. So 50 lakh will be my impairment loss in this case, right? 50 lakh would be the impairment loss. Clear? Yes. So this is my impairment loss. And what is my recoverable amount? It is higher of fair value less cost to sale or value in use. This is my recoverable amount. Right, friends? Yes. Friends, now let's discuss the first concept, right? When I'm talking about the first concept, identification of an asset that may be impaired. Identification of an asset that may be impaired, right? So friends, why identification of an asset that may be impaired? Impair ho sakti hai, right? So why it is important? First of all, as I have told you, that impairment is not a theoretical exercise. Impairment means you have to engage your valuers as well for doing the fair valuation, right? For example, if there is a Reliance, Adani, these big companies are there, right? Nestle, ITC, Tata Motors, Tata Steel. So these companies have plants across India, across the globe, right? They have big plants, they have big machineries, right? So if they have to do the impairment testing, they have to engage the experts and valuers to find out the value in use, to find out the fair value, right? So it is, of course, a cost expensive exercise, a cost impulsive exercise, and a time consuming exercise, right? The time will be taken and cost will be also taken. And probably after doing all this exercise, you will find that there is no impairment, right? So standard says that an entity shall assess at the end of each reporting period. At the end of each reporting period, an entity shall assess at the end of each reporting period whether there is any indication that an asset may be impaired, whether there is any indication that an asset may be impaired. If indication exists, then only estimate the recoverable amount. So friends, first of all, the entity has to assess at the end of each reporting period. What entity has to assess? Is there any indication that an asset may be impaired? So friends, in my example of a car, what was the indication that I have to check the market value of that car? Friends, what was the indication? The indication was government has came up with the announcement of banning the diesel car, right? And that is why it becomes so famous after the COVID. The institute has also come up with a guidance note on impairment as well. The guidance on impairment in the situation of a COVID. So what was the indication that asset may be impaired? The indication is COVID, right? In the indication is COVID. What was the indication that a machinery may be impaired? The machinery which that company bought from China. The indication was government has banned the output produced from that machinery, and that was the indication which indicate that the asset may be impaired. I'm not saying the asset has to be impaired, may be impaired. But how will you be aware that yes, there must be an impairment? If the indication exists, in that case, you have to estimate the recoverable amount. So if the indication exists, then you have to engage the experts and business valuers or valuers to estimate the recoverable amount. What is recoverable amount? It is higher of fair value less cost to sell and value in use. This detailed calculation, this detailed measurement has to happen, right? So, but this is required to be done only when the indication is there. Only when the indication is there. Have you understood this, friends? Have you understood this, or you have not understood this? Tell me. Have you understood this, or you have not understood this? Understood? Is it clear? So friends, I am sharing my Excel file, and please let me know if my Excel file is visible. So friends, we are discussing Ind AS 36 impairment of assets. We have discussed the objective. We have discussed the scope. Okay. We have discussed the objective. We have discussed the scope. And of course, we have discussed that what is meant by recoverable amount. And here we have discussed that recoverable amount is higher of fair value less cost to sell and value in use, right? We have discussed these three concepts also. Clear? So friends, we have discussed the recoverable amount concept as well. Recoverable amount. I hope my Excel file is visible. So what is recoverable amount? What is recoverable amount? It is higher of what? It is higher of what? Fair value less cost to sell and value in use. Okay. It is higher of fair value less cost to sell and value in use. Okay. And I have told that fair value less cost to sell, it's a market driven value. It's a market driven value. It's a market value. And value in use is a entity specific value. Right? And we have discussed that here the value can be derived from, here the value can be derived from, value can be derived from so indication I will discuss, Rahul. Indication so far I have not discussed. I will discuss indication, right? So in case of fair value less cost to sell, value can be derived from exit point of view. What is meant by exit point of view? From exit point of view means from selling the asset. If you have to sell the asset, what is the value? Selling the asset. Here value in value in use, value can be derived from continuance point of view. What is meant by continuance point of view? Means using the asset, right? Means using the asset. And how this value in use can be derived? The value in use can be derived by present value of future cash flow. So fair value is as simple market value. So this is fair value, which is market value minus your cost of disposal. And in this case, it will be present value of future cash flows. Future cash flows. Cost to sell or value in use is 200 and 188 lakhs. So friends, let's say, take one more example. Let's say the carrying value is 200 lakhs and fair value less CTS is 150 lakhs and value in use is 140 lakhs, right? So what is the higher here? What is the higher value? The higher value is 150 lakhs, right? So in this case, what is your recoverable value? Your recoverable value is higher of fair value less cost to sell and value in use. What is higher between these two? 150 lakhs. So recoverable value is 150 lakhs, right? Then what is your impairment loss? What is impairment loss? Impairment loss is carrying value minus recoverable value. So it is 200 minus 150. Minus 150. It is 50 lakhs is your impairment loss. 50 lakh is your impairment loss, right? Clear? Is it clear, guys? Friends, let's continue with this example. Let's continue with this example. For example, here carrying value is 200 lakhs. And when you calculated fair value less cost to sell, for example, it comes out at 210 lakhs, right? So the carrying value is 200 lakhs and when you computed fair value less cost to sell, it came out at 210 lakhs, right? Now tell me whether you will go for value in use calculation, whether value in use is critical, is important to calculate here. In this situation, will you calculate value in use? Do I need to compute value in use? Tell me what is your view? Do I need to compute value in use? No. Why? Because the concept of recoverable amount is higher of fair value less cost to sell and value in use. Even though if the management will compute value in use and if it is lower than fair value less cost to sell, then at least this will be the recoverable amount, right? Because the concept is not lower, the concept is higher. So if the fair value less cost to sell is 210 lakhs and we understood that it is more than the carrying value, in this case, there is no need to compute value in use, right? Why? Because in any way, of course, you have to take higher. Doesn't matter if the value in use comes out in, let's say, 300 lakhs. Still, we are not revaluing our asset. What we are doing, We are only checking the impairment loss, right? And from the one value, we have understood that it is more than the carrying value, and hence there will not be any impairment. So in this case, there is no need to use, there is no need to compute value in use, right? There is no need to do value in use calculation, right? So likewise, for example, the carrying value is 200 and the value in use is, let's say, 210 lakhs. Do I need to compute fair value less cost to sell for getting the recoverable value? Fair value less cost to sell for getting the recoverable value? Answer is no. I am not required to compute the fair value less cost to sell because one value is already higher than the carrying value. It means there is no impairment. And why we are computing value in use or fair value less cost to sell? Only to check the impairment. If you are doing the revaluation model in PP, in that case, cost to sell, value in use is not required, guys. In case of revaluation model, you have to see only market value. As simple as that. So if you are opting for revaluation model, the revaluation could be higher, could be lower. If it is lower, it is impairment. If it is higher, it is revaluation surplus, right? We are only talking about calculation recoverable value. What is the recoverable value? It is higher of value, which is already higher than your carrying value. Then another value is not required to compute. You got the answer from the first value itself that there is no impairment, right? Clear? Is it clear, guys? Okay. Koshiki, there is no concept of positive impairment. There is no concept, right? Either there could be impairment or there could not be any impairment. Means you should continue with the carrying value. As simple as that, right? Soham is saying, sir, fair value less cost to sell is higher than value in use and the management is not willing to sell the asset. Then also recoverable amount is equal to fair value less cost to sell. Then also recoverable amount is equal to, yes, Soham, doesn't matter whether management is willing to sell the asset or does not willing to sell the asset. Computing fair value as cost to sell does not mean that you have to sell the asset. Soham, the only thing is, so see, what is meant by market value? Market value means the value which you will get when you will sell this in the market, right? But what is meant by value in use? As the name suggests, what is meant by value in use? The value which you will get when you will use the asset. In my example of a car, where you are using that car for transportation purposes, if you will use the car, then only you will get the money or you will earn the money from that car. Na? So value in use is from using the asset, and that is why you are computing present value of future cash flows. But in market value, you are not computing any present value of future cash flows. Why? Because market value means you go to the market and get the value. As simple as that. Understood? Soham, is it clear? Right? Great, guys. So friends, we have discussed objective scope. We discussed the concept of recoverable amount. Now we are discussing the first concept. And what is the first concept? Identification of an asset that may be impaired. Identification of an asset that may be impaired, right? So standard says that at the end of each reporting period, what to do at the end of each reporting period? What is required to be done at the end of each reporting period? Management should check if there is any indicators of impairment. Management should check if there is any indicators of impairment, right? Management should check if there is any indicators of impairment, right? And if indicator are there, if indicator exists, if indicator exists, then what to do? Manini, what to do then? If indicator exists, then estimate, then do the impairment testing. Do the impairment testing. Impairment testing means you have to engage the valuers or experts, and they will compute the fair value less cost to sell. They will do the value in use calculation, do the impairment testing, and estimate the recoverable amount. Do the impairment testing and estimate the recoverable amount. You need to estimate the recoverable amount. Is it clear? Is it clear, guys? Is it clear or not clear? Yeah. So now again, I came back to my PowerPoint presentation, which must be visible to all of you. Yeah. So we discussed this, that at the end of each reporting period, the management has to check, is there any indicator of impairment? If there is indicator, in that case, you have to estimate the recoverable amount, right? Now, what is meant by, what are the indicators of impairment? The indicator could be, so what is indicator of impairment? Have you seen the car? There are two indicators, left indicator, right indicator. So likewise, impairment has also two indicators, which is internal indicator, means which is within the entity, which arises within the entity, right? What is external indicator? Which is beyond the entity, which is outside the entity, right? So friends, what is internal indicator? What is external indicator? Let's talk about internal indicator first. There is evidence of obsolescence or physical damage, right? Let's say you got a car. The life of the car is 10 years, right? And the car met with an accident. Okay. So there is evidence of obsolescence or physical damage. So when the car met with an accident, whether the value of the car will go down or it will not go down. Although you will get the door replaced, you will get the engine replaced, right? You will incur a lot of expenses, but the value of the car will go down or it will not go down. Of course, it will go down. The value of the accidental car is of course less, right? So, but is it always less? It would depend. It would depend, right? But is it an indicator to check the recoverable value? Answer is yes. This is an indicator, right? So evidence of obsolescence or physical damage is an indicator of impairment, right? Is an indicator of impairment, right? When you go to the old building, right? The cost of the old building is lower than the cost of the new building, right? For example, when I was, looking for a flat to buy in Gurgaon, so I was discussing with the property dealer. So he asked my budget and I told him that this is my budget. Okay. So he told me that in this budget, you will get the flat in the society, but in the society, you will only get the flat in the old societies, right? And the flat must be 10 years old, 15 years old, 12 years old, right? And you have to incur some money on their renovation as well, on their repair as well. Okay. So I told him, no, I want to buy a new flat. Okay. So he told me, if you want to buy a new flat, or let's say the flat which has been ready, constructed in the last 1 or 2 years, so you have to pay 25 or 30 lakh rupees extra. So what does it mean? It means, why I'm getting the older building at a cheaper price? Because of course, that building requires some renovation, some repairs, right? And that is why the value of the building is lower than the value of the new building, even in the same vicinity, even in the same area, right? So friends, don't get confused, and please try to understand that we are only talking about the possibility of impairment due to some indicators. We are not saying that if these indicators are there, there will always be impairment. It cannot be so, right? For example, the prices are shooting up for the land, right? If the land prices are shooting up, of course, the building will situated on the land only, na? Then the value of the building will go up, right? So there could be a scenario, but yes, if there is a evidence of obsolescence or physical damage, this is an indicator of impairment. But there could be a scenario, instead of getting the value down, the value could be increased due to the high demand. It could be increased, right? So that you will be able to know only when you will do the impairment exercise. You will do the impairment testing. You will go into the market and check the fair value. When you will engage the valuer and he will get the fair valuation, right? Understood? But yes, this is an indicator of impairment. Is it clear? Is it clear? So Manini, that's what I have told you, right? That due to the accident of the car, it is an indicator. Doesn't matter. And this is not always necessary that always the price will go down, right? But yes, it will call for checking the recoverable value, right? Clear? This is an indicator. Asset remaining idle. You're not able to use that asset. The asset is remaining idle. You have purchased a machinery, but due to the lower demand, the asset is remaining idle. You're not able to use that asset. Again, it is an impairment indicator, right? You have to check the recoverable value. If the asset is remaining idle, so it means probably your market value is not that declined, but probably your value in use will go down, right? So you have to check the impairment. In this case, you have to check the recoverable amount. You have to do the impairment testing and you have to check the recoverable amount of impairment. Declining asset performance. The asset performance is regularly declining, right? Earlier, the machine was producing 10,000 units per day. Now the machine has started producing 8,000 units, now 5,000 units. So there is a declining asset performance, which is again an indicator which calls for impairment, right? Is it clear? Now, so we discussed the internal indicators. Now we are discussing the external indicators. What is meant by external indicators? Significant decline in market value. Significant decline in market value. So the asset value has been significantly declined, right? The asset value has been significantly declined. And I will take an example of this, real life example. 4 years ago or 5 years back, I purchased a Samsung S9 Plus phone. Samsung S9 Plus phone. And I purchased that phone at a cost of 65,000 rupees, right? 65,000 rupees. Normally, the life of the mobile phone is 3 years normally. So let's say if I have to charge a depreciation, it would be, if it is the cost is 65,000 rupees, then per annum depreciation would be 20,000 rupees. So what is the carrying value at the end of the first year? The carrying value at the end of the first year was 65 minus 20, let's say 30 or 45,000, right? And after 1 year, somehow I was checking the price on the Flipkart of Samsung S9 Plus phone. That phone was available at a price of 32,500. Can you imagine that? 1 year ago, 1 year back, I have purchased at a price of 68,000 rupees, 65,000 rupees. I purchased at a price of 65,000 rupees. And now that phone, after 1 year, that phone was available at 50% price, which is 32,500 rupees. So there is a significant decline in market value. Why? Because of competition, because lot of new phones are there, and Samsung is also upgrading its phone on a regular basis, right? So that is why the older version get cheaper. So friends, the crux of the story is, if there is a significant decline in market value, again, it is called for checking the recoverable value. Sir, let's say if there is a significant decline in market value, but value in use is still higher. In that case, what will happen? Of course, you have to check higher of fair value less cost to sell and value in use. As simple as that, right? Is it clear? So significant decline in market value is an external indicator to check recoverable amount. Changes in technological, market, economic or legal environment, right? or legal environment. For example, the technology has been changed. Kodak. Have you heard about Kodak? Have you heard about Nokia keypad phones? Right? So after this digital photography, the market of Kodak was badly hampered, right? So due to the change in technology, the old technology become outdated, right? And again, this is one of the external indicator to check for impairment, right? Market value, right? Change in market value, economic or legal environment. Change in market value, not market value, change in the market or market scenario. Earlier, the asset was trading in Indian market. Now it gone ban in Indian market. Again, it is an external indicator to check for impairment. There are legal restrictions, right? Legal environment. Again, it is a indicator of impairment, right? Changes in interest rates. The interest rates are increasing. The interest rates are increasing. Is it an external indicator? Yes, friends. If the interest rates are increasing, your discount rate will also increase. How you will calculate your value in use? You will calculate your value in use by discounting your future cash flows. For example, your future cash flow, let's say after 1 year, the cash flow is 100 rupees and 1.1, right? So when you do 100 divided by 1.1, what you will get? What you will get 100 divided by 1.1? What you will get, friends? 100 divided by 1.1, you will get 90.90. You will get 91. You will get 91. Let's say the interest rate has increased. It becomes 15%. Now, you will calculate present value by 100 divided by 1.15. So friends, in this case, the present value, what will be the present value? 100 divided by 1.15, what will be the present value? It comes out at 87. It comes out at 87. What does it mean? If interest rate will increase, your value in use will go down. Again, it is an external indicator of impairment. It is an external indicator of impairment. Low market capitalization is again an external indicator of impairment. Vodafone Idea Limited. The market capitalization, the value of the shares of Vodafone Idea, the market capitalization of Vodafone Idea is lower than the asset value, lower than their balance sheet value, right? It is again an external indicator of impairment. Sir, is it an exhaustive list or is it an indicative list? This is an illustrative list, indicative list. This is not an exhaustive list, right? Is it clear? So these are the indicators of impairment. These are the indicators of impairment. I'm not saying that the impairment will always be there. I am saying these are the indicators because we have read that the management has to check at the end of each reporting period. Is there any indication of impairment? Which indication? Internal indication or external indication as well, right? If there are indication, you have to estimate the recoverable amount, right? And what is the recoverable amount? It is higher of fair value less cost to sale and value in use. Is it clear? Is it clear, guys? Very good. So Manini is asking, sir, who is doing all this verification? Is entity's own employee or outsourcing? So Manini, it depends on the capability of the company, right? Of course, if I talk about who is doing, management is doing, right? So management has to check whether there is an impairment indicator or not. If yes, management has to check the recoverable amount. So if the management can check the recovery, if the management has proper projections, proper future cash flows, probably the employees can check the value in use. Like in our company, we are calculating value in use, right? But if the management does not have a good number of people in finance, like they don't have good number of chartered accountants, they don't have that kind of capable person, so probably in that case they need to outsource this, right? Like in the same case, Manini, you must have seen that many companies are filing their GST returns at their own, right? Many companies are outsourcing the GST return. Again, it depends upon the capability. which they have building within the company. The reporting, Manini is again asking the second question. The reporting date and impairment measurement date may be same or different. It may be different. It could be near to your reporting date as well. For example, if you have checked the impairment in the month of February, you are not required to check in the month of March again, right? Market capitalization means, for example, the outstanding number of share is, let's say, 1 crore for any company, right? Outstanding share means the shares which they have issued, and the market value is, let's say, 100 rupees per share. So what is their market capitalization? 100 into 1 crore, 100 crore is their market capitalization, right, Koshiki? Yes, very good. So Rahul has very beautifully explained, and he has written that, sir, these indicator, internal indicator and external indicator, only suggest that the company has to go for a detailed impairment exercise, which means the company has to estimate the recoverable amount by measuring the fair value less cost to sell or estimating the present value of future cash flows. You are right, bang on, Rahul, right? So basically, these indicator only suggest that you need to do this exercise. It does not mean that there will always be impairment. Probably there could not be impairment, right? Perfect. Friends, identification of an asset that may be impaired, and what are the indicators? Friends, there are three assets. There are three assets where impairment testing is mandatory. Where impairment testing is mandatory without looking for indicators. So this is an exception. What is the exception? So far I have told you, if there is an indicator, then only you have to go to check the recoverable amount. Then you have to go for the impairment testing, right? But there are three exceptions. What are the three exceptions? There are three assets, irrespective of whether there is any indication of impairment. Doesn't matter, impairment is, indicator is there or indicator is not there. Doesn't matter, right? There is no evidence of obsolescence, no physical damage, no disposal, right? No market decline, no market capitalization lower, no increase in interest rate. There is nothing. Still, you have to check the impairment for these three assets on an annual basis. For these three assets on an annual basis. What are those three assets? These all are intangible assets. Intangible asset number one. Intangible asset with an indefinite useful life. For example, there are intangible assets which is having an indefinite useful life. For example, you have purchased a company, right? And when you have purchased a company, you have paid for some customer related intangibles, right? You have paid for some brands, right? Some copyrights. And there is no time limit for these things. So basically, there is no time limit till when you will get the future economic benefits. There is no time limit till when you will get the future economic benefits, right? It means the life is indefinite. What does it mean? It means the life is indefinite, as simple as that. So if the life is indefinite, will you be able to amortize? If the life is indefinite, will you be able to amortize that asset? Of course, answer is no. How will you amortize that asset? You will not be able to amortize this asset, right? You will not be able to amortize the asset because there is no denominator, there is no life. In that case, you remember Ind AS 38 says that for an intangible asset which is having an indefinite useful life, you have to check for impairment on an annual basis, right? So for intangible asset with an indefinite useful life, you have to do the impairment testing on an annual basis, at least once in every year. Intangible asset not yet available for use, right? There are intangible asset which is not yet available for use. Again, for these intangible asset, you have to do the impairment testing on an annual basis. Goodwill acquired in a business combination. You have done an acquisition and you have purchased a goodwill. So basically there is a goodwill, right, which is arised due to business combination. I believe you must have gone through with Ind AS 103. You must have read Ind AS 103. So if there is a goodwill which is arised in business combination, in that case, again, you have to do the mandatory impairment testing. Friends, if you will look at these three assets, there is no depreciation or amortization in these cases. And that is why there is mandatory impairment testing should be there. Is it clear? Sumit, as I have told you, that the list of indicators are not exhaustive. This is indicative, illustrative, right? Rahul is asking, sir, like COVID-19 pandemic, if there is decline in value at one reporting period, but we know that this is condition specific, still will there be impairment? Rahul, you have to look at the impairment on the reporting date, right? Whenever you are finalizing your books of accounts. Okay. So, for example, when you are closing 31st March 2020 or when you have closed 31st March 2021, there was impairment, you have to book the impairment. But if the situation will improve further, you will reverse the impairment, right? Because you are preparing the balance sheet as on the balance sheet date. Your balance sheet should be as at. It will reflect your statement of financial position on the reporting date, right? So in that case, it may call for impairment, but the impairment will be reversed if the situation will improve, right? So friends, let's go to the Excel file again, and please confirm if my Excel file is visible. Please confirm if my Excel file is visible, guys. So guys, let's talk about the exceptions. In case of below assets, the impairment test goes below assets. Asset number 1, intangible assets having indefinite useful life, right? What is the second one, guys? What is the second one? Intangible assets not yet available for use. What is the third one? What is the third one? Goodwill acquired in business combination. Goodwill acquired in business combination, right? These are the three assets which is having exception. Now let's discuss some important concept relating to these three assets, right? So coming to the notes, okay? Please write down. This is the important aspect. Note number 1. The impairment testing is mandatory on the above three assets at least once in a year. So what does this mean? It means if let's say in the year, it is not necessary to do the impairment testing on a reporting date, right? Let's say the company has done the impairment testing in quarter 2 or quarter 3, right? For any of these assets. So in this case, it is sufficient. If the company has done the impairment testing in quarter 2 or quarter 3, it is sufficient. And in that case, the company is not required to do the impairment testing again in the Q4. Okay. So it has to be done at least once in a year. Okay. The frequency and timing should be consistent for impairment testing on a year-on-year basis. What is the second requirement? The frequency and timing of impairment testing should be consistent on a year-on-year basis, right? Let's take an example. This is financial year 2021. This is financial year 21-22. 21-22. There is a first asset, let's say, intangible asset with indefinite life, right? Intangible asset with indefinite life. So this intangible asset with indefinite life has been checked for impairment, has been tested for impairment in Q3. So it is okay. if it has been tested for impairment on Q3, the impairment exercise has been done in Q3, it is okay. But in the next year, the impairment testing should not be in Q1. So it means it should not be after 6 months. Okay. Or it should not be in Q2, or it should not be in Q4. In the next year, the impairment testing should be in Q3 only, right? In the third quarter only, so that the frequency and timing should be consistent, right? For example, there is another asset, intangible asset, not yet available for use, right? Not yet available for use. It has been checked for impairment. It has been tested for impairment in Q2. So again, in the next year, it has to be checked for impairment in Q2 only. For example, goodwill. Goodwill has been checked for impairment in Q1. So again, it has to be checked for impairment in Q1 only, right? Is it clear? Is it clear? Or if you have any doubt, please tell me. Third and very important, let's say intangible asset having indefinite life is acquired in January 22. There is an intangible asset where the life is indefinite, and this intangible asset is acquired in January 2022. Whether impairment testing is required on this asset in FY 21-22. So friends, the concept is the impairment testing is mandatory on these assets at least once in a year. But this asset has been acquired just 2 months back before close of the year. Now the question is whether impairment testing is required on this asset in FY 21-22. What is your view? What is your view? Guys, yes. Yes, this is a third important note. Yes. The impairment testing is mandatory at least once in a financial year, right? So it is mandatory at least once in a financial year. I hope with this Excel file, things are clear to you. I will share this Excel file with Board of Studies of ICI, and they will upload on the portal, right? I hope it is clear to all of you. Let me know if there is any doubt. Please let me know if you have any doubt. Is it clear to all of you guys? Yeah. Have you understood? So on these three assets, there is an exception of checking the indicator of impairment. You are not required to check the indicator of impairment. You have to do the mandatory impairment testing and checking the recoverable value for these three assets. These all are intangible assets. First is indefinite life intangible. Second is not yet available for use. Third is goodwill. Self-generated goodwill is not allowed in Ind AS 38, right? Okay, Rahul. So goodwill acquired, only acquired goodwill. And what are the important notes? The important criteria is first, the impairment testing is mandatory on all these exceptional assets at least once in a financial year. Frequency and timing of impairment testing should be consistent on a year-on-year basis, which I have explained you with the help of this example, right? And even though if the intangible asset is acquired during the year, still impairment testing is mandatory for that intangible asset. Again, I am repeating and reiterating. Doing impairment testing does not mean that you have to do the impairment. Doing impairment testing means you have to check the recoverable amount. What is your fair value less cost to sell and what is your value in use, right? So Koshiki is saying, sir, in January 22, we know market value as we bought it from market, right? Yes. So in that case, Koshiki, of course, you will not do the impairment testing in January 22 only. You will do the impairment testing in March 22, just to check that the fair value has not been gone significantly, declined significantly, right? Or let's say the value in use is still there, which you have expected. Srishti is saying, sir, if it appears 2 times about impairment, then it need to be done 2 times. Yes, Srishti. So the mandatory is at least once. Please see the word uses at least once, right? For listed companies who are reporting their results on a quarterly basis, even they are checking the impairment on quarterly basis if there are indicators, negative indicators, right? Right, Srishti? So mandatory requirement is at least once. The mandatory requirement is not only once. Have you got it? It is not saying that you have to do only once. It is saying that at least once. Clear? So guys, it's 8:28 now. Let's have a 10 minutes break. Okay. So we will meet at 8:37. Okay. 8:38. And we have also discussed about, the exceptions, that what are the exceptions where, in spite of the fact that even though indicator is there or indicator is not there, you still have to go for impairment exercise. I mean to say, you have to go for estimating the recoverable value, right? Harshad is saying, sir, impairment means the asset is not at its correct value due to the external or internal indicators, and we need to book asset at its correct value by making provisions of impairment. Correct, sir? Yes, Harshad. The only one correction is, for example, when you are doing a estimation of recoverable value, for example, the carrying value is 100 rupees only, and while estimating recoverable, you got that the fair value is, let's say, 110 rupees, right? But in spite of impairment, there would be the upside by estimating the recoverable amount. So in that case, you are not required to correct the value of the asset, right? In that case, you have to see if it is a PPE or intangible asset or investment property, right? So if you are using a revaluation model, in case of PPE or intangible asset, only in that case the value of the asset will change. Otherwise, the value of the asset will not be increased. Okay. The objective is only to see the downside. The objective is not to see the upside. Clear? As per this standard, as per Ind AS 36. Right, Harshad? Friends, can you please confirm my PPT is visible and I am audible to all of you? Yeah. Okay. Any doubt, any challenge so far? So I'm not getting any response from the participants. Yeah, great. I got the response now. Yes. So Manini is asking, the time gap between two testings should be the first testing date or second one if there is more than one testing in a year. So Manini, in Manini, in that case, it should be you have to look from the second impairment testing. Okay. For example, the first impairment testing happens in Q1. The second impairment testing happens in Q3. So you have to look from the Q3. Srishti is saying, sir, means fall in revaluation and impairment are same. Bang on, Srishti. Yes. So fall in revaluation surplus. So fall in revaluation and impairment is one and the same thing. You can say that, right? But upside, impairment, you cannot book the upside, right? For recognizing the upside, you have to go to the respective standard. Is it clear? Good. So Koshiki saying calculating recoverable value does not mean actual impairment. It is just impairment testing. Bang on, Koshiki. You have, made a very concrete point. So Koshiki is saying calculating recoverable value does not mean actual impairment. It is just a impairment testing. So might be when you are doing this recoverable value calculation, you will find that your value is higher than your recoverable carrying value, right? So if the value is higher than carrying value, then you are not required to do anything to your carrying value. Your carrying value will be good to continue, right? But if the recoverable value is lower than the carrying value, in that case, you need to do the correction. Means you need to decline your carrying value to the extent of recoverable value and you have to charge the impairment loss. Yes. So friends, let's move on and discuss the next concept. Recoverable amount is higher of an assets or cash generating unit. Cash generating units means group of assets, right? And we discussed this fair value less cost to sell and value in use, right? It is not necessary to calculate both an asset's fair value less cost to sell and its value in use if either of these is higher than the carrying value. As we discussed, if you've computed, let's say, fair value less cost to sell or value in use, and you find that one value is already higher than the carrying value, so you got the answer that there is no impairment. There is no need to check the another value in that case, right? Yes. Now let's discuss what is meant by fair value. So fair value is largely a market value, right? It's a market value, and fair value definition is given under Ind AS 113. So probably you must have covered Ind AS 113. So this fair value definition is also given under Ind AS 113, which says that fair value is a price that would be received to sell an asset. Please see, to sell an asset, or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This is the same definition which is given in Ind AS 113, right? And what is your cost of disposal? Your cost of disposal is an incremental cost. Incremental cost means directly attributable cost, right? Directly attributable to the disposal of an asset or a cash generating unit, excluding finance cost and income tax expenses. So basically, cost of disposal is a directly incremental cost, directly attributable cost, which arises only due to selling or disposing of that asset. For example, legal cost, stamp duty, and similar transaction taxes, cost of removing the asset, directly incremental cost to bring an asset into condition for its sale, right? So cost of disposal does not include your finance cost and income tax expenses. So friends, when you are disposing of this asset or you are selling this asset, probably you have to incur some income taxes, right? So that income tax will not be considered as a disposal cost. Or if there is some finance cost, right? For, for bringing the asset into the condition of sale. For example, you have to sell a power plant, or you have to sell a plant. So in that case, you have to do the dismantling, you have to do the packaging, and then you have to ship to that plant let's say to the foreign country. The buyer is into the foreign country and he is saying that you have to ship this entire plant to their location, then only they will do the payout. So in that case, you have to take some borrowings, you have to take a loan just to facilitate or incur these kind of cost. So if you will take the borrowing for just due to the fact that you have to do the dismantling, you have to do the packaging, you have to do the shipping, right? So although it is a directly incremental cost which is arising just due to the disposal of this asset, but the finance cost which is incurring on this borrowing, this finance cost will not form part of your cost of disposal for calculating fair value less cost of disposal. Clear? Is it clear? Is it clear, guys? So example of cost of disposal is legal cost, stamp duty, similar transaction taxes, cost of removing the asset, directly incremental cost to bring an asset into condition for its sale. It does not include finance cost and income tax expenses. Clear? Okay. Let's do this case study. ABC Limited owns a bottling plant located in one of its factory. The professional valuers have estimated that the current value of the plant is 10 lakh rupees. The valuation fee was rupees 1 lakh. So they want to sell so basically this is a bottling plant located in one of its factory, and the valuers have estimated that the current market value of the plant is 10 lakh rupees. And the valuation fee which they have taken for valuing the plant is 1 lakh rupees. ABC need to dismantle the plant and deliver it to the buyer. So the company has to dismantle the plant and deliver the entire plant to the buyer. Dismantling cost is rupees 2 lakh. And for this, the dismantling cost which will incur is 2 lakh rupees. There should be a specialized packaging cost because it's a plant. So there should be a specialized packaging cost. It would be 1 lakh rupees. And the legal fee would be rupees 0.5 lakh rupees, 50,000 rupees. Determine its fair value less cost to sell. What is the fair value? So the valuers have estimated the fair value, the market value of the plant is 10 lakh rupees. Now tell me, what is cost of disposal? What is cost to sell? Guys, what is cost to sell? Tell me. This valuation fee, tell me whether this valuation fee will be taken as a cost of disposal. Is it a directly attributable cost? Koshiki is saying 6.5 lakh is a fair value less cost to disposal. So guys, there is a dismantling cost of rupees 2 lakh. it has to be deducted. Yes. There is a packaging cost of 1 lakh. It has to be deducted. Yes. Legal fee of 0.5. Whether it has to be deducted, answer is yes. It has to be deducted. But what about valuation fee, friends? What about valuation fee? Whether it is going to be deducted? Answer is no. Why? Because valuation fee is not a directly attributable cost. The company has incurred a valuation fee for estimating the fair value. If the fair value would have been the higher, probably if the fair value would be higher, so it could be a decision making factor, and probably the management may think of that we are not going to sell this plant, right? So the valuation fee is not something which have been happened after taking a sale decision, right? So they are getting the valuation done only to take a decision whether they need to sell or they will not go for the sale, what suits the price, right? So valuation fee is not a directly attributable cost. And whomsoever has told that 6.5 is the fair value less cost to disposal, this is the right answer. Valuation fee is not a directly attributable cost. It is not arisen just because the company is going to sell, right? So it is not a necessary charges, Srishti. Srishti, tell me, if you are going to sell an asset in the market, right? Of course, you will sell by looking at the market value, you will sell, right? So whatever market is there, you will be fetching that value. But before going into the market and before proposing a sell, you are getting this valuation done from the valuers, right? So that you are just understanding, that am I getting a right price for my product or not? As simple as that, right? I'm not saying that it is not a necessary charges, but I am saying that whether it is a cost of disposal, answer is no. It is not a cost of disposal. It will also charge to P&L, right? But as far as cost of disposal is concerned, in cost of disposal, only those costs needs to be taken which is directly related to the disposal. Valuation fee is not directly related to the disposal, right? Will it be a sunk cost? Yes, Sumit, this will be a sunk cost, right? Srishti, it is not a cost of disposal now. Might be after doing the valuation, you will take a decision that I'm not going to sell this asset, right? But after packaging, but when you will do the specialized packaging, when you will incur the selling cost, brokerage and license fee, brokerage and commission, when you will pay that, when you will dismantle the plant, when you are dismantling the plant, of course you will dismantle the plant when the sale has been decided, right? Only then you will dismantle the plant. Understood? It is a cost. It is not a cost of disposal. Cost of disposal means the cost which is directly related to the sale. Now coming to the value in use. So we have understood, and this value in use is not a new term for all of us because we are a CA final student, and in CA Inter in accounting standard 28, we have also read the concept of value in use. So value in use talks about the present value of future cash flows. Of course, when I'm talking about future cash flow, it is expected to be derived from an asset or a group of assets. Present value of future cash flows. When I'm talking about future cash flows, so whether this future cash flow is only inflow or only outflow, or it is both, only inflow or only outflow, or both, it is both, right? So the inflow as well as outflow relating to that asset, right? When you are considering inflow, you have to consider the outflow as well. For example, a teacher who is running a coaching institute, right? He is saying that from this coaching institute, from this building, I'm getting, let's say, 10 lakh rupees per month, right? But he has to consider, for earning a 10 lakh rupees, he is incurring a cost of 2 lakh rupees every month, right? So it means for calculating the present value, you have to take both. Why? Because probably if you will go into the market and sell the asset today, which is your fair value, right? You are not required to incur those outflow as well. Of course, if you will sell the asset, you will not be able to incur inflow. You will not be able to earn inflow. but you will also not incur outflow as well, right? It means you will not say that, oh, I will forego 10 lakh rupees per month income from this asset. But guys, there is a 2 lakh rupees of cost as well. So you have to take both inflow as well as outflow. You have to consider inflow net of outflow, right? So primarily two key decisions are involved in determining value in use. So friends, in this case, what is meant by present value? Tell me what is meant by present value. So present value means you have to discount it to the today's date. Okay, you have to discount it today, right? So for calculating a present value, what you is required? You are required to have a discount rate, and you have to estimate your future cash flows, right? Is it clear? So two key decisions are involved in determining the value in use. And what are the two key decisions? First, estimating future cash flows. Second, discount rate. Am I right? First, what is my cash flow? Second, at what rate I should discount my cash flow to get the present value, right? Discount rate. Cash flow and discount rate. Is it clear? Yeah. So friends, I want all of you to please ready with pen and paper, and please write down this concept, whatever I'm telling you to write. Okay. So fair value less cost to sell, you must have written down that fair value less cost to sell. It is fair value is a market value, and cost of sale is directly related to the cost of disposal, the cost which is related to the disposal, right? And coming to the value in use is present value of future cash flows. Cash flow will be inflow as well as outflow from that asset, right? Two key important things are there in value in use. One, estimating the future cash flow. Second, estimating the discount rate so that the present value calculation can be done. Okay. Friends, there are some key concepts. Okay. What are the key concepts? First of all, estimate of the future cash flows the entity expect to derive from the asset. So basically, while estimating the cash flow, you have to estimate the cash flow only from the asset or group of assets which is subject to impairment, right? For example, you have 3 plants. One is located in Gujarat, one is located in Manesar, and one is located in Delhi. So you are going to impair, let's say, Delhi plant. You are checking the impairment testing of Delhi plant. So in that case, while calculating the value in use of Delhi plant, you have to see the estimated future cash flow of Delhi plant only, right? You are not required to see the estimated future cash flow of Gujarat or Manesar plant. Understood? So first, the cash flow estimation should be from the particular asset or group of assets only, right? Of course, this is but obvious, na? Expectation about possible variation in the amount or timing of those future cash flows, right? So while estimating the future cash flow, first we understood that it is related to or specific to that asset or group of asset only. Second, you have to consider the expectation about possible variation in the amount or timing of those future cash flows. For example, you are expecting that I will be able to receive the cash flow from this particular asset from the 3rd year only, from the 4th year only. So you have to, for example, the life of the asset is, let's say, 10 years, right? And you are aware that in the initial 2 years, I will not be able to generate cash flow, but from 3rd year and onwards, I will be able to generate the cash flow, right? So you have to consider those all possible variation while estimating the future cash flow, because the timing is again very important, right? For example, if you are saying, no, I will be earning the cash flow from today only, the present value will be higher. But if you will say, I will be able to generate the cash flow from the 3rd year, the present value will be lower, right? So time value of money is again an important concept, and that is why the timing is very important. And other factors such as illiquidity that market participants would reflect in pricing the future cash flows the entity expect to derive the asset. So basically, it is saying that when you are estimating the cash flow, you have to check all the conditions, right? So your projection should be very concrete and very robust, right? Your projection should be not be in the air, that whatever you have want to give, you have given. So there would be proper justification, there would be proper backup for those projections, right? For example, you are doing an impairment testing for a plant, and that plant is in an installation phase. So you are aware, and it is but obvious that this kind of plant would take at least 1 year for the entire installation and for being ready for use, right? Available for use. So in that case, you cannot say that, no, I have already considered the cash flow right from the day one, right? So you have to consider the cash flow from the second year onwards. What could be the basis for the cash flows? The basis should be reasonable and supportable assumption of management, best estimate of the economic condition over the remaining useful life of the asset, right? So there must be a reasonable and supportable assumptions of the management best estimate for those cash flows, for earning those cash flows, right? For example, in case of a tower industry, right? So normally they take the life of the telecom tower as 20 years, right? And their best estimation is also due to the industry precedent, due to the past experience, they are aware that the tower life is close to 20-25 years. They will be able to generate the revenue from the towers from the next 20 years, right? So there is a reasonable and supportable assumption of the management for the remaining useful life of the asset. Greater weight should be given to the external evidence. So friends, the standard says that, and it's not only about standard, even the auditing standard says that for doing any estimation, you have to rely more on the external evidence, right? Not on the internal evidence. For example, management is saying that I have to recover 5 lakh rupees from my debtor, right? So auditor will be asking, okay, you are saying that you have to recover 5 lakh rupees from your debtor, but whether your customer is also confirming that he has to pay you 5 lakh rupees. And that is why the auditors are rolling out confirmations. Am I right? So why the auditors are rolling out confirmations? The auditors are rolling out confirmation just to check from the external parties, right? So hence, it is not only an accounting standard concept, it is an auditing standard concept also, that the greater weight should be given to the external evidence. For example, management is saying we will be able to generate cash from this asset in the next 10 years. But the technical valuer is saying, or let's say, the life of the product, the life of the asset is printed as, let's say, 8 years, right? In that case, you have to take the cash flow for 8 years, not for the 10 years, right? Clear? Is it clear? Okay. Most recent financial budget or forecast that have been approved by the management, and every company is preparing their AOP, annual operating plans, right? Or future forecast. Many companies are preparing these future forecast financial budgets, and they are preparing on an annual basis. So even this is written in the standard that whenever you are talking about estimation of future cash flow, you have to rely on the most recent financial budget or forecast, which is approved by the management, which is approved by the board, right? And projections would cover a maximum period of 5 years unless a longer period can be justified. Friends, even Ind AS 36 says that whenever you are projecting a cash flow, you have to consider cash flow for a maximum period of 5 years, because longer the period, longer will be the uncertainty, right? So it says that you have to consider a maximum period of 5 years unless a longer period can be justified. For example, in case of aircraft, the aircraft is costing, let's say one aircraft is costing 20 crore rupees, 25 crore rupees. If they will take a period of 5 years, every aircraft will be impaired, I would say. They will not be able to generate such cash flow in the 5 years so that the cost of the aircraft would be recovered, right? So friends, and the life of the aircraft, even as per the technical valuers, or life of the aircraft as per the manufacturers, as per the manufacturer's warranty, manufacturer's guidance about the life of the aircraft, it is close to 20 years, 15 years, right? So in this case, the cash flow projection should be taken for 15 or 20 years only, right? The cash flow projection has to be taken for 15 or 20 years only. Clear? But if the life is uncertain. If you are not clear about that till how many years it will go, so it should be covering a maximum period of 5 years unless a longer period can be justified. Clear? Is it clear? Yeah. Friends, just give me 2 minutes. Someone is there on the door. I have to just open the door. Just give me 2 minutes. Any doubts so far, guys? Any doubts so far? These are the theoretical concept, right? But yes, these concepts are applicable in the practical life as well. Let me know if you have any doubts so far. I believe everything is clear. I believe you guys are comfortable. Good. So in the first slide, we have discussed that how this cash flow has to be reflected, right? And there we have discussed the cash flow is related to a particular asset. You have to consider all the possible facts and circumstances while estimating the cash flow. Then we have discussed there should be reasonable and supportable assumptions of the economic condition over the useful life of the asset. Then we have discussed the external confirmations or external evidence should be given more importance in comparison to the internal evidence, right? Then we have discussed that the most recent financial budget or forecast has to be taken. Then we have discussed that the projection should cover a maximum period of 5 years, right? Unless a longer period can be justified. Clear? Cash flow includes. Now, what to include in cash flow and what not to include, right? For example, let's say there is a transport company and the transport company has let's say 10 fleet of cars. They have 10 cars, right? And they have deployed their car in the schools just to for the transportation or for the commutation of school kids from the school to residence and the residence to school. So first of all, this transport company is earning 50,000 rupees per month revenue from using these cars, right? Standard says that the cash flow should be estimated for the assets in the current condition, right? What is meant by in their current condition? Current condition means whatever you are earning as of now, right? So you have to take the cash flows as per the current condition only. For example, tomorrow you are expecting that, after 3 years, if there will be any improved technology, for example, let's say today I am giving 20,000 rupees to my driver, okay, for driving these cars. And after 2 or 3 years, since there is a technology which is in the talks, right, where the talks are going on, that it should be the driverless car. Right? So this company is also thinking that after 3 years or after 4 years, because the remaining life of the car is 10 years. So after 3 or 4 years, I will invest in the technology and I will make these cars, I will improve this car, or I will make these car driverless cars, right? And in that case, after 3 or 4 years, I will not have to incur the driver salary cost. So standard says that no, you are not allowed to do these kind of things while estimating your current cash flows. So it says that you have to estimate cash flow in the current condition. For example, if today you are paying a salary of 20,000 rupees to a driver, you have to estimate the driver salary for the next 10 years as well, right? So you cannot consider the expenditure in improved technology, and you cannot consider the savings due to the improved technology as well while estimating your future cash flows. Cash inflows from the continuing use of the asset. Second, you have to take the cash inflow from the continuing use of the asset, right? So whenever you are, of course, here we are estimating cash flows. So we are not estimating cash flow from selling the asset. We are estimating cash flow from the continuing use of the asset till the end. Third, of course, here we are talking about cash inflows. It means here we are talking about earnings, and here we are talking about expenses. So cash outflows which are necessarily incurred to generate the cash inflow from the continuing use of the asset, right? So if you will see, the first condition talks about the cash flow in the current condition. Cash flow in the current condition. The second condition talks about the inflow. The third condition talks about the outflow, the third point. The fourth point talks about net cash flow, if any, to be received or paid for the disposal of the asset at the end of its useful life. So, of course, it is talking about cash inflows during the life of the asset. But at the end of the life, there will be a terminal value. Do you understand what is meant by terminal value? So the value which you will receive at the end of the life of the asset, right? So while estimating the cash flow, you have to estimate the cash flow in the current condition. Second, you have to estimate the cash flow in cash inflow from the continuing use of the asset. You have to estimate the cash outflow, which is necessary to be incurred for generating this inflow. And whatever you will get at the end of the useful life of the asset, you have to estimate that as well. Right? Is it clear? Manini is asking, sir, except exceptional assets, impairment of asset measurement is optional. Yes, Manini, it is optional. But again, if the impairment indicator exists, in that case, it is not optional. It becomes mandatory, right? For example, the company is earning regular losses. So in that case, the company has to check for the impairment losses, right? The company has to check the impairment testing. The market value of the company has declined. Again, it is an indicator of impairment. And in that case, the company has to do the mandatory impairment testing. For exceptional asset, you are not required to check the indicator. But for other asset, you have to require to check the indicator. If any trigger is there, in that case, it will calls for impairment. What is not required to be included? What is not to be included in cash flows? Future restructuring to which an entity is not yet committed. So let's say the entity is doing a valuation of a plant. The entity is doing a calculating a value in use for a plant. And while doing the value in use for that plant, the entity is saying that, after 5 years, we will be relocating to a different place, to a remote place where the cost of maintaining this plant will become very low, right? Where the labor will be very cheap, right? And the rent or other cost will also go down substantially after 5 years. So answer is no. The company cannot expect such kind of restructuring which is not yet committed while doing the projected cash flow. So guys, why standard has given so much restrictions and so much clarity? Because it is again a subjective thing, right? It is a subjective thing. You are checking impairment, right? You are estimating your value in use, and value in use is an internal thing, right? Fair value is something which is a market driven, but value in use is internal thing. Okay. So while calculating value in use, probably it's again a projection, so that management will not, just to avoid the impairment, management will not calculate the fake value in use. Management will not increase the artificial value in use. So that is why these kind of things have been given. Okay. These kind of things have been given, right? That you are not required to, you should not consider the future restructuring just to increase your cash flow. Okay. improving or enhancing the asset performance, right? So you cannot consider any cash flow due to the enhancement or asset increase in the asset performance in future. Okay, you cannot expect these cash flows. Cash inflow or outflow from financing activity, you cannot, you cannot expect cash inflow or outflow from financing activity. You are saying that I will mortgage this asset and will get a loan. You cannot consider that loan as a value in use from that asset. So cash inflow or outflow from financing activity will not be considered. Income tax receipts or payments. Okay, again, as you have seen that in cost of disposal, finance cost and tax expense is not to be considered. Likewise, the cash flow on account of financing activities and income tax receipt or payment is not required to be considered. Right? Is it clear, friends? Is it clear? So Koshiki Singh sir, if committed, then also it will not be of current condition. So Koshiki, if it is committed, right? In that case, of course, it is not for in a current condition, but there is an exception where standard says that if the entity has already committed, they have already obligated to do, right? They have already the complete plans in hand that after 2 years they are relocating. In that case, Koshiki, they have to consider this, right, while estimating the future cash flow. Okay, is it clear? So guys, we have discussed a lot about estimating future cash flows, right? We discussed a lot about estimating future cash flows. I hope you guys have written this. Now let's discuss the second part, which is discount rate. What is the discount rate? Generally and practically, the discount rate is a market rate of interest, right? So the discount rate should be a pre-tax market rate which reflect the current market assessment of the asset, right? Of the time value of money and the risk is specific to the asset. Guys, why it is saying that the risk is specific to the asset and why it is saying to the time value of money? Of course, discount rate is nothing. It's a time value of money. Present value. What is present value? It's a time value of money, right? The value of 100 rupees today is not equivalent to the value of 100 rupees after 1 year, right? The value of 100 rupees after 1 year is 96 or 95 or 90 rupees today is the value of 100 rupees after 1 year, right? So friends, standard says that the discount rate should be a pre-tax market rate, pre-tax rate. First of all, you need to understand what is pre-tax. For example, the discount rate is 10%. Friends, for example, the rate of interest is 10%. The borrowing rate is 10%, right? The borrowing rate is 10%. So let's say if you are incurring a cost of 10% on account of borrowing, so you have to incur a finance cost also. If you have taken a borrowing, you have to incur a finance cost also. You have to incur a finance cost also, right? So in the P&L, if you will incur a finance cost, let's say 10% is the borrowing rate. If 10% is the rate of interest and you have to incur a finance cost of 10 rupees, let's say, so you will get a tax deduction out of that. You will get a tax deduction out of that because interest cost is allowable cost. So let's say tax rate is 30%. Tax rate is 30%, right? It means you will get a benefit of 3 rupees, right? So let's say if 10% is the interest rate, right? And tax rate is 30%. What is the post-tax expense? Post-tax expense is 7%, right? For example, if you are incurring 100 rupees, there is a salaried person and the salaried person is in a 30% tax bracket. For example, you are earning a salary of 50 lakh rupees and you are into 30% tax rate, right? And you are making a donation of 2 lakh rupees. So by doing a donation of 2 lakh rupees, you will get a tax rebate of 30%, which is 60,000 rupees, right? So what is your net cash flow? Your net cash flow is 1,40,000 rupees. You have paid 2 lakh rupees, but you are saving in taxes for 60,000 rupees. So the net cash outflow is 1,40,000 rupees. So which is kind of a 7%, right? So whenever you are incurring 10%, you will get a tax benefit of 30% on it. So basically your post tax rate is 7%. So standard says that since you are ignoring taxes, standard says that since you are ignoring your taxes, right? So it says that you have to use, while calculating a discount rate, you have to take a pre-tax rate. The tax rate should be a pre-tax rate. So in the question, if it is given that 7% is, let's say, post tax rate, 7% is a post tax rate. Please write down, if in the question it is given that 7% is a post tax discount rate and the tax rate is 30%, and please calculate the recoverable value or value in use. In that case, for finalizing the discount rate, you have to compute the pre-tax rate. How will you compute the pre-tax rate? Let's say, please let me know if my Excel file is visible. Let's say for discount rate, it says that discount rate should be always pre-tax rate. In the question, let's say post-tax rate is given. Post-tax rate is, for example, 7%. Right? And tax rate is also given, which is your 30%. Tax rate is also given 30%. What is your pre-tax rate? If post-tax rate is 7%, right? Post-tax discount rate is 7%, tax rate is 30%, means this 7% is equivalent to 7% is equivalent to 70%, right? So it will give you the pre-tax rate. So it is coming at 10%, right? So if tax is 30%, it means this 7 comes after deduction of 30%. It means 7 is equivalent to 70% only. If 7 is equivalent to 70%, then what is the full value? The full value is 10%. So by this way, you can compute your pre-tax rate, right? 7 divided by 70%. So this will give you the 10% of pre-tax rate. Clear? So you have to use this pre-tax rate for all the calculations of value in use. And in this case, for example, let's say the value in use, how you will compute the value in use? For example, this is an year 1, 2, 3, right? And this is your discount rate. Pre-tax discount rate is 10%, which is again a 10% is your discount rate. This is your present value factor. So what is your present value factor in case, and this is your cash flow. Cash flow is, let's say, 100, 200, 300, right? This is your value in use, which is present value. Present value is your value in use, right? So you are computing value in use. So now let's calculate the present value factor. Present value factor. So how will you calculate present value factor? So the discount rate is 10%. So 1 divided by 1.1, right? This will give you the discount present value factor for first year. When you divide 1.1 from this, it will give you the discount rate factor for the second year. It will give you the present value factor for the third year, right? And when you multiply the cash flow with the present value factor, it will give you the present value. So your present value of the total cash flow, which is your 600, is 481. This is your value in use. What is your value in use? Your value in use is how much? It is 481.59. I hope you have understood these calculations, guys. I hope you have understood these calculations, right? Is it clear? Is it clear? No, opportunity cost should not be considered in value in use, right? Clear, friends? So let's go to the slide again. So friends, the standard says that the discount rate should be the pre-tax rate, first of all, right? The second, standard says that the discount rate should be in relation to that specific asset. And I'll take an example, guys. For example, there are two companies, right? One company is into real estate, right? The second company is into, let's say, into FMCG like Nestle, like ITC, right? So friends, the real estate company is taking a loan from the bank, right? And real estate is again a sensitive sector, right? And so the same bank, let's say HDFC Bank is lending to Nestle and HDFC Bank is lending to a real estate company. So same bank, same pool of fund, they will charge a higher rate of interest to the real estate sector in comparison to the FMCG sector, right? Because let's say if tomorrow COVID will come, so of course people will not buy real estate, people will not buy properties, but of course people will buy grocery, right? People will buy grocery, but people will not buy properties. Right? Tomorrow, if the recession will come, the price of grocery will not go down. You will not say that due to recession, I'm getting a flour, suji, maida, pulses, right? So I'm getting it a 50% price. But if the recession will come, the real estate value will go down because the demand will not be there, but supply will be there. Everyone would like to be get out of the property and will get the cash in hand, right? So friends, that is why, since when you are doing an impairment, you are doing an impairment of an asset. So standard says that whenever you are computing the discount rate or just identifying the discount rate should be more from the perspective of that particular asset, right? For example, if I will go into the market and get the funding for this asset, at what value I will get the funding, right? For example, if it is a real estate property, at what value I will get the finance for this particular asset for a period of, let's say, 10 years, right? So you have to see from that product perspective. Sir, if the product is specific, if the asset is specific, discount rate cannot be computed. Generally, it is difficult to compute. In that case, standard says that you have to go by below hierarchy. The first one is you have to see the entity's weighted average cost of capital. And this weighted average cost of capital is available for every company. Every management computes what is my WACC. What is my WACC? And I believe this is not a new concept for you guys. This is not a accounting and reporting concept. This is financial management concept. And you must be knowing what is your weighted average cost of capital, right? Like we are using weighted average cost of capital for computing value in use, right? So generally and practically, companies are applying weighted average cost of capital. If weighted average cost of capital is not there, then you have to see the entity's incremental borrowing rate. Means if today I'm going to take a fund from the bank, at what rate of interest this company will get the money, right? So normally the companies are asking for the quotation from the bank that we want to have a 500 crore rupees of loans, right? For a period of, let's say, 10 years. So what interest you will charge to us, right? So auditors are asking for these kind of quotation to check the discount rate or other market borrowing rates. Generally, you are aware that in the market, normally the borrowing rate ranges from the 8% to 9%. For example, for the home loans, you must have seen that there is a lot of advertisement for home loans, right? That for 20 years, you are getting a home loan at the rate of 8.9% to 9.1%, right? So in that case, you have to apply the other market borrowing rate. So friends, the first preference is to get a interest rate specific to that asset, right? For example, the life of the asset is 10 years. So you have to get the interest rate that if such asset, if the finance has to be taken for such asset, then what will be the interest rate? If it is not available, generally it is not available. In that case, you have to apply entity's weighted average cost of capital, right? The second one should be, if even that is not available, then at what value I am getting a loan from the bank, as simple as that, right? And if that is not available, then other market borrowing rates you can also refer, right? Let me know if there is any challenge in understanding here. Yeah. So guys, I'm trying my level best to explain you this complex standard in a most simplest manner, right? So that you will be able to understand this. Right, guys? Is it clear? Clear, not clear? Tell me. Is it clear or it is not clear? Is it clear, friends? Koshike, is it clear? Srishti, Sumit, Rahul, Nandini. Okay, very good. So friends, now let's discuss. So we discussed the value in use. Now let's discuss if the value in use in foreign currency, then what to happen? For example, I'm a company located in India and I have a foreign currency future cash flows. I have a property which is in foreign currency, right? Which is in foreign country, right? And I'm incurring money in foreign currency. I am getting money in foreign currency, right? And now I need to compute the value in use, right? And of course, it's an Indian company, so you are finalizing the books of accounts in India only, right? It's an Indian company, but you have some assets in foreign country. So of course, you need to record the impairment, and you need to record the impairment in Indian books only, right? Because the assets are there, the entity is not there, the assets are there, right? The assets in your books only. So friends, standard says that, first of all, for computing the value in use, two things are important. One, cash flow. Second, discount rate. So standard says that, don't worry. First of all, you need to estimate the cash flow in the foreign currency itself. Estimate the future cash flow in the foreign currency itself, right? You have estimated the future cash flow in the foreign currency. Second, standard says that you have to use the discount rate. Discount rate using rate appropriate for that currency. For example, guys, if today you are taking a loan for, let's say, house property, loan for home loan in India, it will cost you 9%. But if you want to buy a house in USA or in Dubai, so probably you have to pay 4%, 3%. So there, the interest rate is very cheaper. That is why the people are living luxury life, right? You must have heard about your neighbor who went to US 3 years ago and he bought a big house. He bought a big flat, right? And you're just thinking here that I'm still living in a rented accommodation and that guy is buying a home in USA. So friends, because it is affordable. Why? Because there is the interest rates are very low, right? The interest rates are very low. But in India, the interest rate is very high. If you are paying an EMI for a home loan and the EMI is, let's say, 40,000 rupees, you will be surprised to see that in the first year, how much you have paid. If you have paid 40,000 rupees per month, you have paid 4,80,000 rupees per year. For a 20-year home loan, if you have paid 4,80,000 rupees in the first year, probably your principal would be hardly 25 or 30,000. 4.5 lakh rupees will be only on account of interest. Can you imagine that? But if you will pay the same money in USA, 4.8 lakh rupees, probably your interest will close to 3.5 lakh rupees or 3 lakh rupees, and your 1,80,000 rupees will be on account of interest in the first year. So guys, that is why standard says that wherever your asset is located, wherever, so estimate the cash flow in that currency only. Then it says that please use the discount rate which is relevant for that currency only, right? After that, so once you have estimated the cash flow in the foreign currency, then apply the discount rate in the foreign currency, you will be able to compute the value in use in the foreign currency. Have you got it? Step one, what is your step one? What is your step one? Your step one is to estimate cash flow in foreign currency. Please write down. Your step one is estimate cash flow in the foreign currency. Step number two. What is your step number two? Step number two. Finalize the discount rate, finalize the discount rate in foreign currency. So whatever discount rate is applicable in that foreign currency, you need to finalize that discount rate, right? So after that, you will compute step 3. Compute value in use in foreign currency. You will be compute the value in use in foreign currency. Step number 4. Step number 4. Convert or translate the foreign currency value in use applying the spot rate. Sir, why spot rate? Because today you are computing impairment, right? So let's understand this with the help of this case study given in the institute study material, right? So guys, let's discuss this case study. On 31st March 2001, XYZ Limited makes following estimate of cash flow for one of its assets located in USA. So guys, what is your step 1? Step 1 is estimating the cash flow in foreign currency. So these are the cash flows. First year $80, second year $100, third year $20. Step number 1. Right? Second step. So guys, the discount rate is given in INR for INR and US dollar. So guys, which discount rate we should opt? India or USA? Which discount rate we will apply? India or USA? Which discount rate we are supposed to be opt for? 15% or 10%, guys? Yes, 10%. Perfect. 10%. Step number 2. You have to take 10%. Right? Exchange rate. Then, and you are computing your impairment on which date? 31st March 2001. Right? So the exchange rate is given 31st March 2001 for $45, 45 rupees per US dollar. And for every year, the exchange rate is given. It is not relevant, friends. Applying step 1 and step 2, you will get a value in use in foreign currency. Right? You will get a value in use in foreign currency. Right? And how will you do the computation? Let me show you. And once the value in use will be calculated in foreign currency, you have to convert it into the INR using the spot rate. And why spot rate? Spot rate means the rate on which you are doing the measurement of recoverable amount. Right? Understood? Is it clear? So we need to calculate value in use on 31st March 2001. Please let me know if my Excel file is visible. Please let me know, guys, if my Excel file is visible. Is it visible? So value in use calculation in case of foreign currency cash flows. Step 1, calculate the future cash flow in foreign currency only. Estimate the discount rate applicable to the foreign currency only. Step 3, calculate value in use in the foreign currency, right? Step number 4. Convert the value in use into Indian currency using spot rate, right? And let's discuss this case study now. Solution to the case study. Right? And let's discuss the solution to the case study. Okay. So first of all, year. And what is the year? Year is 2001 to 2, 3, 3, 4. This is the year which is given in the question. 1, 2, 2, 3, 3, 4, right? So what is your first step? What is your step number 1? Step number 1, your cash flow in foreign currency. Foreign currency cash flow. cash flow in US dollar, right? I'll write it as a US dollar. And what is the cash flow given? $80, $100, $20. The total cash flow is $200 in 3 years. This is your step one. What is your step number two? Your step number two is, what is your step number two? What is your step number two? Your step number two is apply the discount rate applicable to the foreign currency, right? So you need to compute present value factor at the rate of 10%, which is your discount rate in USA. What is your present value factor, guys? 1 divided by 1.1. Again, this divided by 1.1. Again, this divided by 1.1. It will give you a present value factor, right? What is your step number three? What is your step number three? What is your step three? Compute value in use, compute present value. So present value, right? And present value is value in use. What is your value in use in foreign currency? Your value in use in foreign currency is $170.40, right? And this is in dollars. And let me write down here present value in USD. So guys, what is step number 4? What is step number 4? Step 4. Convert USD value in use in INR using the spot rate at 31st March 2001. What is the spot rate which is given at 31st March 2001? 45 rupees per US dollar, right? So what is that? This is rupees 45, INR 45 per US dollar, right? INR 45 per US dollar. So it will comes out at 170.40 multiplied by 40 multiplied by 45. So this will be your 7668. This will be your 7668 will be your value in use in Indian currency, VIU in Indian currency for the purpose of impairment, right? This is your VIU in Indian currency, right? Sir, for example, so this is value in use. For example, the fair value of that property. Of course, you will look at the fair value in US market only. If the property is located in US, you will be able to sell in US only. So in US, let's say the fair value of the property is, for example, so this is your value in use calculation. But for recoverable amount, you have to compute fair value also. For example, in case of fair value less cost to sell, I'm just extending this question. Fair value less cost to sell. Cost to sell in US is, let's say, $150, right? So that fair value less cost to sell is also pertains to a measurement date only, which is 31st March 2001. So of course, in this case, you have to apply again spot rate, which is 45 rupees per USD. So in this case, it will also comes out at 150 multiplied by 45. It is 6750. So what is higher? 6750 is higher or 7668 is higher? 7668 is higher. So you have to take 7668 as a recoverable amount. If let's say it should be 250, then what will happen? In that case, you have to multiply with 250. It is 11250. So 11250 will be higher. In that case, your recoverable value will be 11250. Have you understood this? So let's extend the above example and assume if fair value less cost to sell is also given in the question, then what is the recoverable amount? Right? So that you guys will not get confused when you will see this Excel file after 1 month, 2 months, 3 months. So you will be able to understand that I have already, I have assumed and I have extended this example. So in this case, fair value less cost to sell is 250 USD, right? Since this fair value is again at 31st March 2021, so it has to be converted using the spot rate at 31st March 2021, right? So what is that value? That value will become 11,250. And how this value have been arrived? 250 multiplied by 45. So in this case, recoverable value will be is equal to higher of VIU and FV less CTS, right? So in this case, your recoverable value will be 1100,250. Right, friends, is it okay? Please tell me if it is okay. Clear? Is it clear, guys? Great. So friends, so I am posing here. It means I am not further going. I'm not going further for and taking other concepts as well. So let's discuss what we have learned since morning, and I'm going to conclude this class in the next 5 minutes, right? So please let me know if you have any query so far. So friends, we have started with the concept impairment of assets, and we discussed what is the difference between depreciation and impairment, right? Then we have discussed the agenda. We discussed that the objective of this standard is applicable largely for PPE, intangible asset, investment property, and goodwill. And the objective of this standard is to correct the carrying value and reduce the carrying value to the recoverable value, only as far as reduction is concerned, right? Then this standard also talks about how to determine the recoverable amount, which is higher of fair value less cost to sell and value in use. This standard also talks about allocation and reversal of impairment loss and disclosure aspects as well, right? This Ind AS 36 is applicable to all assets except the assets where the impairment is taken care by the asset itself, the standard itself, right? I have also taken example for that. Coming to the impairment loss, whenever your carrying value is higher than the recoverable value, there should be an impairment loss, and you have to charge the impairment loss so that your carrying value should be corrected, right? So what is my recoverable value? We have discussed this, right, friends? Then we have discussed that impairment testing is not a theoretical exercise. It requires a lot of time and money as well. And that is why standard says that it is not a compulsive exercise. You have to go for impairment testing only when you have an indicator of impairment for a particular asset or group of assets, right? So what is meant by indicator? The indicator will be of two types. One is internal indicator, one is external indicator. So you are feeling that the performance of the asset is declining. You are feeling that you are not getting the productivity out of that assets. You are looking at that, yes, the asset is physically damaged. I have expected that the life should be 10 years, but it is physically damaged. So it means I have to charge accelerated depreciation. I have to charge impairment, right? So you are already planned for discontinuation of business, right? Again, it is an indicator of impairment. Or there could be external indicator like decline in market value of that asset, change in technology, change in the legal environment, right? Like BS4 vehicle. Have you heard about BS4 vehicle? These BS4 vehicle, the companies were selling these BS4 vehicle at a very low cost. Why? Because the government was banning those vehicles, right? BS4 vehicles. So you change in interest rate. If the interest rate is continuously increasing, it is a indicator of impairment. Low market capitalization, again, it is an indicator of impairment, right? So then we have discussed that recoverable amount is of course a higher of fair value less cost to sell and value in use. Since it is higher value, so if you have computed one value which has already cleared that no impairment should be there, you are not required to compute value in use, right? Then we have discussed what is meant by fair value. Fair value is a market value as per Ind AS 113, and cost of disposal is the incremental cost which is directly incurred only on account of selling the asset, only on account of disposal of the asset. And it is not including any finance cost and tax expense. Okay. And we have taken the example of cost of disposal like legal cost, stamp duty, similar transaction cost, remove cost of dismantling, removing the asset, directly incremental cost to bring an asset into condition for its sale, like special packaging cost, right? And we have discussed one case study also. Then we have discussed what is meant by value in use, and we discussed that since value in use is present value of future cash flow, so two things are very important. First, knowing what is your future cash flow. Second, discounting those future cash flow to arriving at present value. Then we have discussed that your cash flow should be reflected in such a manner that first of all, it should be specific to the asset or group of asset. Second, you have to consider all the facts and circumstances so that your cash flow projection should be correct and accurate, correct and close to accurate, right? Then we have discussed that reasonable and supportable assumption of management based estimate should be there for the remaining life of the asset. If the management is not clear what is the life of the asset, how can they compute the cash flow for that asset? Greater weight should be given to the external confirmation and evidences. Management has to see the most recent annual budget and forecast, and it should be largely for a period of 5 years, but longer period is also okay if it can be justified, right? Then we have discussed that the cash flow should be estimated for asset in the current condition. I have taken example of that driverless car also, right? I have taken an example of a plant also where you are going to relocate. So then you have to take a cash inflow from the continuing use, cash outflow, which is necessary for earning cash inflow, and your terminal value cash flows as well, right? What is not included in the cash flow? Future restructuring to which an entity is not committed, right? Improving or enhancing the asset performance, improving or enhancing the asset performance, right? For example, you are thinking that in future, I will improve the asset performance by which my cash flow will also improve. You cannot take that, right? Cash inflow or outflow from financing activities as well as taxes, right? Discount rate, we have discussed that the discount rate should be a pre-tax market rate, pre-tax rate. Discount rate should be specific to the asset. If you cannot identify the specific discount rate specific to the asset, you can go for weighted average cost of capital. You can go for the incremental borrowing rate or other market borrowing rate in the descending order, right? Then we have discussed the foreign currency future cash flows. So if your asset is located outside India, how to compute the value in use or how to compute the fair value less cost to sell in Indian currency. So then we have discussed first, you need to compute the cash flow in the foreign currency only. You have to compute the discount rate in the foreign territory only. You have to compute the value in use in the foreign currency only. Since you are doing the calculations today, so you have to convert on the today's rate, that foreign currency multiplied by the today's exchange rate should be your INR amount, right? And we have discussed how this calculation will happen in the Excel file, as well as we have discussed how it will be impacting my fair value less cost to sell as well, right? I hope it is clear to all of you guys. Let me know if you have any doubt. If not, I want to conclude the session. Manini legal cost includes valuation fee too. So Manini in legal cost, valuation fee will not be covered. You have to see if valuation fee has been incurred after the sale, and it is important for the sale to happen. In that case, it has to be taken. But if any valuation which has been done before sale, it is not required to be taken, right? Koshiki terminal value means residual value, means the scrap sale, the value from the sale of scrap. So thank you, Manini, for your feedback. And guys, I hope you have enjoyed the session thoroughly. So I have seen there was a lot of interaction and participation from the students, and I have responded and replied to every queries of the participants, right? And I hope you guys have understood the concepts very well. Thank you so much, and we will meet day after tomorrow just to conclude this standard, right? And I want you guys to go through with the study material and read yourself so that you will get the best out of these classes. Thank you so much, guys. Bye-bye. Take care.